Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the podcast, I'd like to return to the meme stock frenzy of 2021. And what I'm talking about here is, you might recall, AMC and GameStop at the beginning of 21 had their stock prices just spike and go through the roof. And we had a lot of headlines about people trading these stocks from their basement because they were communicating on Reddit threads. And you had all these funny usernames like Roaring Kitty and Deep Expletive Removed Value, who were driving up the prices of these stocks that were otherwise not tremendously successful investments. Now that we're a little ways removed from this time period, a number of people have had the opportunity to study the behavior of these stocks and what actually happened. And one study came from the SEC around options activity and whether that actually drove up the prices of the stocks further. Another study that came out of Harvard, from a Harvard researcher, took a look at whether the stimulus activity drove prices of retail stocks up, in particular these meme stocks. And now we just have a whole bunch of research and a much better idea of what actually happened during this period. And come to find out, it gives us a couple really important investment lessons that are wonderful reminders of how we should invest our portfolios in general. So today, what I wanted to do is rehash all this and walk through, remind everyone what happened during this time period with these companies, walk through what we've learned since then, and the outcome and conclusion of a couple of these studies. So this is a fun episode to record. Some of it does get a little bit technical with options activity and so forth, so forgive me for that. But again, it gives us just a wonderful lesson on time horizon and irrationality and how we should think about investing our portfolios as prudent investors. I hope you enjoy it. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. So this week on the podcast, I'd like to circle back to something that happened in the markets here at the beginning of last year that you might all remember, and that's the meme stock frenzy. And just to jog everybody's memory, I'll give you all kind of a breakdown of what was going on at the time. You remember all this frenzied trading around GameStop, AMC, and then there were several hedge funds involved, and Robinhood, the free online brokerage, retail brokerage firm, was pretty heavily involved in this. And basically, there was a lot of momentum that started from Reddit message boards around investing in these companies. And there were a couple people that wrote persuasive enough threads on Reddit to convince a bunch of people to put their investment dollars into these stocks. And that messaging and that momentum grew enough to really drive the price up. And this was really interesting because the headlines at the time and the way that this was positioned in the media is that it was kind of like a, David versus Goliath kind of story, where you have hedge funds on one end that are betting against these companies because they have dying business models and their fundamentals look really poor. And then you have these small investors trading out of their basements, communicating on message boards that are winning the game and creating enough positive momentum to drive the prices up. And you heard about people, putting in a little bit of money into these things and then watching the price just skyrocket. And then all of a sudden the size of their account is like $10 million when they put in maybe 10,000 to begin with. And this was a really big deal in the news for a while. And we had a lot of people we talked with who were very interested in investing in these stocks. We had some clients who invested in these stocks. We had some spouses of clients. And, in general, we really tried hard to talk people out of that because the fundamentals remained so poor. But this is a really interesting issue at the time. And so now that things have settled down, remember, this is back in the beginning of last year, beginning of 2021, we've had an opportunity to study this a little bit. And we haven't done a whole lot of research at our firm about this topic specifically, but we've read up quite a bit from other studies that have been done by the SEC and by a number of other researchers, mostly in academic settings. There's a pretty good paper that came out of Harvard surrounding whether the stimulus money that was doled out across the country contributed to stock market bubbles and meme stock frenzy in the first place. The SEC did an investigation about whether the options activity in these stocks really did drive the prices up in this call option vortex, was the kind of the lingo of the day. And so today, now that we're a little bit removed from that, I want to circle back and just kind of give a synopsis of what actually happened now that we have some more data. The other reason that I wanted to bring this topic up now is there's renewed interest in these two stocks. AMC and GME, AMC Theaters and GameStop, both have spiked a little bit in the last week or two. And the fundamentals of the companies themselves have not changed. They're still losing a ton of money, but for some reason there's a little bit of renewed interest, and the prices have popped a little bit. So it's relevant if you've been following these names today, and enough time has passed where we've had an opportunity to study this, and now we have a better idea of what actually happened. So let's back up a little bit. And one of the as I mentioned, we have this group of people that are communicating on Reddit threads and message boards, and they have usernames like Roaring Kitty and Deep expletive removed value, and all these other kind of funny names. And they're communicating and they're making arguments for being bullish on these two companies. Meanwhile, in the beginning of 2021, we're well into the COVID pandemic. Movie theaters have been closed for a while. AMC is losing money hand over foot. Nobody knows whether people will return to the movie theaters after the pandemic is over, whether these companies will survive at all, or whether AMC will survive. In the case of GameStop, they sell video games. I've never been in a GameStop, but they sell video games and consoles, and a big part of their business is buying used games from people and then selling them secondhand in, kind of with a marketplace kind of aspect to it. Well, people are playing more video games today than they ever have, but this idea of having a brick and mortar location to exchange these things is kind of dying as more of our games go online. So they're two dying businesses. They're both losing money hand over fist. They don't have good fundamentals, but this group of people thinks they're still undervalued stocks because they have promise for some reason. And I don't know what their exact arguments were. I just know that they were losing a whole lot of money and didn't look like a good investment to me personally at the time. So they convinced a bunch of people to get into them. And that created a little bit of momentum. More people got involved. And then at some point, this group of people and others started buying call options on these stocks. So on the one hand, and I'm going to explain what that is in just a moment, but on the one hand, you have a lot of momentum from the message boards and people who've just received a little stimulus money. They're kind of bored, sitting around, don't have a whole lot to do. They throw it into these things, and now they have a good experience because the stock pops a little bit. On the other hand, you have professional investors, the hedge funds of the world, who are trying to find misvalued opportunities to invest either in a bullish or a bearish way across individual securities. And if I'm someone, and I am trained to evaluate stocks and make those calls, I've done that for a long time, I don't recommend it, doing that stock to stock, but there are a lot of institutions and professionals who engage in that activity. And if I'm evaluating GameStop or AMC at the time a year and a half ago, if I'm evaluating them now, they do not look like good investments to me. And there were a lot of institutions who were betting that the price of these stocks go down. So because of the interest generated by the Reddit traders and the meme stock traders driving the price up, that really hurt the hedge funds who were betting against that, directly against that. And the primary method to bet, there are two ways to bet on against a company, two primary ways. There are a lot of ways to do it. But one is to sell the stock short, where you borrow shares from your brokerage firm, you sell them at the prevailing price, and then if you're correct and the price goes down, you can buy them back later. So using this example, if GameStop is trading at $100 a share, which is not the case, it's much lower than that, but if it were, you might be able to borrow shares from your brokerage firm and sell them at $100 a share. So if you sell 10 shares short, it's tough to say, 10 shares short, you wind up with $1,000 in your brokerage account and an IOU to return the shares to your broker. So if the price falls, if you're correct, it falls down to $50 a share, then you can take that $1,000 cash, you buy 10 shares at $50 a piece. It costs you $500. You return the shares to your broker and you walk away with the $500. That's one way to do it. You can also engage in the options market, which I'll explain in a minute. You can buy put options, you can sell call options, you can do a combination of the two. There are a lot of really complex ways to do that. Now, if you're wrong, if you're a hedge fund and you've bet against the prices going up, you've bet that you think they're going to go down, and you're wrong and the price goes up, what happens? Well, you sell shares at $100 a share, you have $1,000 in your brokerage account, and you owe your brokerage firm 10 shares of the underlying stock. Well, if they go up from $100 to $150, you still owe them the stock back. You have $1,000 in your brokerage account, but the value of your IOU is now up to $1,500 because you owe them 10 shares. It's now trading at $150 a share. And the brokerage firm is basically floating you that $500 difference. They're extending you a loan based on the value of your position. And if the price keeps going up and up and up, you have less and less collateral in your account that the brokerage firm is holding to keep your loan open. So there are margin calls in this situation. Stocks can only go down so much. The lower boundary for a stock is $0. They can't go negative, but they have an infinite boundary on the high end. Theoretically, GameStop, if they really turn things around, could go to the moon, as the kids were saying during this time frame. It could go up to $5,000 a share. And if that happens, then you owe $50,000 worth of stock to your brokerage firm. And so if you have that big loan, that big IOU, you owe them back $50,000 worth of stock, but you only have $1,000 cash in your account, they're going to issue a margin call and start closing out positions, and it can spiral out of control pretty quickly. Hedge funds use a lot of that kind of leverage. And there were a couple hedge funds that were short these stocks because they're professionals and, had a pretty legitimate argument as to why they would go down. But they were wrong. The price went in the other direction, and a couple of them had to raise a bunch of cash as a lifeline to keep their positions open and to keep the funds afloat. Robinhood was also involved in this. They were selling and still sell order flow from retail investors to institutions. They halted trading on, I think, both of these securities for a short time, which really angered people across the board. There were all these nuances and complexities. But the crux of it was that these are pretty crummy companies, poor investments, but there was a group of people who thought otherwise and generated enough bullish interest so that money went into the companies and drove the price up. Now, I mentioned options contracts. That's another way to bet on the direction of a company. And I've explained this a little bit on the podcast in the past, but an options contract gives you the right to buy or sell a specific security for a specific period of time at a specific price. And so in our example here, if you buy a GameStop call, one GameStop call option, that gives you the right to buy 100 shares of GameStop at a specific price for a specific period of time. So let's say that GameStop is trading at $50 a share, and you buy a call option at $55 with a strike price of $55 a share that's going to expire in December. That means that between now and December, you can exercise that call option and buy 100 shares of GameStop for $55 a share. Well, right now, if the shares are trading at $50, it's out of the money. It's not worth anything to you, because you could go to the market and buy them for $50 a share. Why would you ever exercise this option and buy them for $55 a share? But between now and December, if the price goes up, now all of a sudden your options could be in the money. And, if the price jumps to $75 a share, well, now that's pretty worthwhile, because you have the right to buy them for $55 a share and pocket the extra $20. $75 minus $55, that is. So once interest began to generate in bullish interest through these message boards, a lot of the traders started buying call options. Now, there's a market for options, just like there is for stocks. And when you buy an options contract, you're buying them from an options market maker. There's a professional out there somewhere in the world who is issuing a call option and selling it to you. And they're matching their book to where it may be another retail investor out there in the world who wants to sell a call option. They're just the intermediary. They buy it from somebody else and then sell it to you. They do have some exposure there. But in this circumstance, there were so many people buying these call options that the market makers didn't have any more options available that they could buy out in the market, and they had to start writing their own. So that sounds a little complex, but think of it this way. If you and I are the only two people in the market and you want to buy a call option and I want to sell it, then I'm going to write up this options contract and sell it to you for a certain dollar amount. And that contract gives you the right to buy shares of GameStop at $55 anytime between now and December. And if the price spikes and you exercise that option, because of the contract that I sold to you, that you bought from me, I am obligated to sell you shares of GameStop at $55. And so at the time, there was a lot of speculation that this activity was driving up the price of these meme stocks further because of what in the lingo that they were using at the time was this options vortex, which is basically a clickbaity way of it's a way to get people to click on media. Basically, it's a total clickbait title. But at any rate, if I'm the options market maker and I'm selling you this option, that gives me exposure. And I don't want to take, if I'm an options market maker, I don't want to take a whole lot of risk, because the price of these things are going up. Even if you think that they're not going to continue going up, or you think they're going to fall back to earth, that presents a lot of risk to the seller of the contract. Because back to our example, if you're buying a contract from me and it gives you the right to buy from me 100 shares at $55 a share, well, that exposes me to risk. And what happens if somebody else comes to me as the option, as the market maker, and says, "Hey, I'd like to buy a call option too at $55." Well, the more activity there is, the more the options market maker is going to be interested in buying the underlying shares of the stock. Because if now 10,000 people want to buy an options contract from me, then I might want to sell them because there's money in it. But then I might also want to take some of that cash and buy the underlying shares of GameStop, because if it does go to $75 a share, now I'm going to lose $20 a share on all of these contracts that I've just sold. And so the theory was that the interest in buying these call options and betting on the price going up, and this is true of GameStop, I keep saying GameStop and AMC all this interest was driving up the prices further because there was simply not enough interest out there in the market to sell options contracts apart from the market makers. And so the market makers were basically forced to buy the underlying shares, which was more bullish on the price and just kept spiraling the price upwards. Well, that's been debunked mostly. There was definitely that activity going on. There was a lot of options activity. Market makers were writing more contracts than they could buy on the open market, and they were purchasing some shares of GameStop to hedge their position and minimize risk. And that's a totally prudent thing to do. None of this is, illegal or nefarious in any way. They're just issuing a product because there are people interested in buying it from them, and they're trying to reduce their risk as a result. But the SEC did a pretty substantial or substantive study on whether or not this activity continued to drive prices up further, and the conclusion was that it did not. It was definitely happening, but it wasn't contributing in a material way to the rise in prices throughout this whole frenzy in Q1 of 2021. Now, the other thing that is that's also interesting is there was a Harvard professor that studied whether or not any of the stimulus payments given to citizens of the U.S. throughout this time frame contributed to stock bubbles, including the meme stocks. And the total, his methodology was basically he compared two groups of 500 stocks. And the 500 stocks were selected because they had high retail trading volume, and the researcher thought they were most likely to be targeted by retail investors. And so if you think back, the total amount of stimulus that was issued throughout this time frame was $814 billion with a B dollars, which is just a whole lot of money. And you can certainly make the argument that was inflationary as well. But his conclusion, part of his conclusion was, after doing the research, was that 100 billion of that 814, so more than 10% of it, made its way into the stock market, which is pretty interesting, right? Because this is stimulus money meant to help people pay rent and buy groceries and just kind of get through the tough times when a lot of businesses were closed and people really had no idea what the next week was going to look like. Well, come to find out, 100 billion of it made its way into the stock market, which is not necessarily a thing you need to exist every single week and month. It's definitely not rent, and definitely not groceries or electricity. And so what they did was they studied these groups of 500 different stocks. Again, they chose the companies selected by retail trading volume, which they can track from information that comes out of brokerage firms. And what they found is, remember, there were 3 rounds of this stimulus. In rounds 1 and 2, in the week after people received stimulus checks, remember stimmies as the kids were calling it back then, this group of stocks spiked by 5 to 7% in the week after stimulus checks 1 and 2. And within 3 weeks after everyone received stimulus checks, the prices rose 15 to 18% and as high as 24% 3 weeks after the second round. And that was materially greater for this group of companies that were likely targeted by retail investors. That was substantially more than other stocks that are not as highly traded in the retail markets. And so the conclusion was that we have $814 billion of stimulus. 100 billion of it inadvertently made its way into the stock market. And I say inadvertently, I think legislators probably knew the whole time that some people who, may have qualified but didn't exactly need it would just take the money and invest it. but I would say that 100 billion is quite a bit more than they wanted and would have anticipated. And, if they had it to do over again, they would probably do it, write up these stimulus bills a little bit differently than they did the first time. Granted, don't want to go off on a tangent here, but they were under the gun. They were under a lot of time pressure, and it was time was certainly an issue that played against them. They didn't have a whole lot of opportunity to present a well thought out piece of legislation. They just had to get something out there, and at the end of the day, there was just a whole lot of leakage. More than 10% of that money given away to people and adding to our federal debt made its way into the stock market and risk assets. But the point here is that this group of 500 companies with more retail volume spiked in a big way and spiked a lot more than other stocks that are not as highly traded in the retail sphere. So the conclusion was that the stimulus absolutely contributed to bubbles in meme stocks. Now, what happened after this, right? This stuff was in the news. We hear all these stories about kids in their basement who put $10,000 in, or 100% of their savings in a lot of circumstances, and now it's worth $10 or $20 million, and they've just had these great returns. Well, since then, everything has come back to earth. AMC has plummeted. GameStop has it's plummeted as well, but not by quite as much. And the interesting thing is that these businesses haven't changed a whole lot. And I'm not a research analyst for any of these companies. I don't know, intimately what is on their agenda and strategic plan for either of the companies, but they haven't turned things around in the last 18 months. And the benefit to the companies of having their stock prices go up, number one, the executives have a windfall. They're often paid and compensated by shares and options and all that stuff. And so when the value goes up, that's good for them. But secondarily, it gives them the opportunity to raise more money and raise more cash. And that's important because both of these companies were losing a lot of money at the time and are continuing to lose a lot of money. And I'll cite a couple financial fundamentals here in a moment. But that's important because, again, think back. Movie theaters were pretty much closed. AMC didn't know what to do with their business to keep it afloat. Now with, the same pandemic pressures kind of behind us and the restrictions lifted, people are going to movies again. My family went to a movie last weekend, and they're able to open their doors, but they still have expenses that exceed their revenues, right? I don't know what they are, but let's say you have $100 million in revenue and $125 million in expenses. Well, where is that extra $25 million of loss going to come from? It comes from your cash holdings. It comes from basically your balance sheet. Either your assets are reduced by that $25 million, or you borrow money to make up the difference. You borrow money, $25 million is added as a liability, or some combination of the two. Well, this can't continue forever. And in the accounting world, we have this grand equation: assets equals liabilities plus owner's equity. If you have $100 million of assets and $75 million of liabilities, you have owner's equity of $25 million. And so if we lose money every single year, the liabilities grow, the assets fall, the equity in the company falls, and it just erodes the value of the company and the value of the shares that you might hold as an investor. So when the stock pops for whatever reason, be it legitimate or not, that doesn't put any more cash in the coffers of the company at all. It's not like it's not like the company is able to take cash out of the like sell, shares that exist. Rarely they will do that. Sell shares that exist and then put the cash in the bank. It gives them the opportunity, now that the price is higher and investors are viewing the company more favorably, it gives them the opportunity to issue more shares. and sell more of the company to the market and then take that cash and stick it in the bank as a lifeline. And so that was the interesting byproduct here is that this activity popped the price. It gave both of these companies an opportunity to issue stock, which they both did, I believe, and put that cash in the bank to fuel growth and their turnaround efforts. It also gave them a lot of activist interest across institutional investors. An activist investor is one that might see a company that's, headed for the toilet, which both of these were, not to mince words, and say, hey, I think that, I've got a turnaround plan for you. I think that we could right the ship and make this a profitable company again. And to do that, I'm going to buy enough shares to give me voting power and a board seat to where I actually have the authority to make those changes. And so over the last 18 months, there have been management turnover. There's been some management turnover at both companies. They have attracted some strategic and active investors in that manner. And like I said, I don't follow either of these companies close enough to know exactly who the names are, but they've both attracted multiple turnaround specialists to come in and change the business model and make them profitable companies again. To date, it hasn't happened. They're still losing a lot of money. And I've got the charts up here. In the case of GameStop, as of today, it's trading at $28.30 a share. Their earnings per share are negative $1.57. So you have your revenues, you have your expenses, and in GameStop's case, they're spending more money than they're taking in revenues. They have a net loss. And that money has to come from somewhere, but it's eroding the value of the shares. And if they don't make some fundamental change to the business model to do something, that will continue, and the stock will eventually go to zero if there's not some change. Now for AMC, it's trading at $9.53 as I sit here recording this episode. AMC is also losing money, almost exactly the same in dollars per share terms of negative $1.59 per share. But the asset base is far smaller, $9.53 a share. That's more than 10% of the equity is being lost every year. And so the prospects for these companies are not good. And like I mentioned at the beginning of the episode, the reason I wanted to bring this up today is because the prices have popped a little bit. The share prices I just rattled off are a little higher than they were a couple weeks ago. And I'm reading things that are saying there is renewed interest in these names. And so if you're someone who is, involved in the meme stock, hopefully you got out at the right time and made a little bit of money from it. But these companies are not strong. They do not have good prospects. They are circling the toilet, in my opinion. And unless something changes substantially with their business models, they will eventually go to zero. They're in dying industries, and maybe they have some debt restructure plan or something to I don't know. Their management can be creative in how they right the ship, but it's just not looking good for either of them. And so the moral of the story here, and as always, you heard the disclaimer at the beginning of the episode. This is not advice over what to do with existing holdings of these companies or your investment dollars or any of that. But it's just a good reminder that stocks and stock markets always come back to fair value at some point. We just have no idea how long it might take to get there. And so the only reasonable way to approach this as an investor is, if you're investing in a diversified way, give yourself enough of a time horizon to allow the market to return to fair value at some point. The longer that you're in the game, the more opportunities you have for this craziness and irrationality to even itself out and return to fair value within your time horizon. Because this whole meme stock thing, the short-term values and prices of stocks can go anywhere. They can go to the moon, they can go to zero. And this whole meme stock frenzy was a pretty good example of that. We had a whole bunch of stimulus being tossed into the markets. It made its way into people's hands. They're home, they're bored. They don't have everything's closed. They're working from home. A lot of people just went to trading their accounts, and they get on Reddit and they see these message boards, and it just spiraled and drove up the prices of these companies, when fundamentally there's no rational reason for these to be any better investments than they were at the end of 2020. There's no reason for the price to go up. They were just driven up by this irrational behavior. But that kind of irrationality happens all the time. We're humans. Humans are just crazy, irrational beasts. And that kind of short-term stuff happens all the time. And so this is just an excellent reminder that we need to be long-term in focus as investors. And the market can stay irrational for longer than we can stay solvent. And that's a famous quote that comes from, I can't even remember who to cite here. It's probably from Benjamin Graham, who was Warren Buffett's mentor. But at the end of the day, we can't forecast what humans are going to do. We know that markets will return to fair value at some point, and if we don't have the capacity, the time horizon to stick around for it, then we shouldn't be taking that kind of risk in the first place, because it is just a crapshoot guessing the price of stocks or groups of stocks over a short period of time. You give me a 20 or 30 year horizon, I'm pretty confident I know what's going to happen. 5, 8 years, not really. 10 years, fairly confident, but not completely confident. So that's it for today. I hope this was helpful. This issue, came up quite a bit at the beginning of 21 when there was a lot of news headlines around it, and then throughout 21 when it unraveled and the prices fell and Robinhood halted trading, and then there was all the options activity, and it was just a very interesting time and interesting for perspective. But again, time horizon is really important. And if there's one takeaway, one bullet point, it's that markets can remain irrational for longer than we can stay solvent. That's it for today, and I will talk to you all again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.